Our first speaker is Bob McNally. Bob was a former special assistant to President Bush and senior director of international energy on the National Security Council. He's the founder and president of the Rapidan Group. He's a member of the National Petroleum Council and non-resident fellow at the Columbia University Center on Global Energy Policy. And he is one of the few people that in 2014 forecasted a decline in oil prices. That was a good. All right. Bob, please.
Thank you very much, Yossi, and I owe you $20 for that mention of my price call in 2014. I am delighted to be back in Israel and at the Herzliya conference. When I began coming to Israel 10 years ago, my introduction with Mickey Altar's help was through the Herzliya conference. It's always been a pleasure. I learned so much, and I congratulate you and the organizers. And I'm delighted to be here with my friends Brenda and Neil as well. I have spent most of my career, whether in the private sector or even in the White House, as a barrel counter, trying to figure out what is driving global crude oil prices. I'd like to share with you today some of the long-term trends that the consensus of barrel counters or oil analysts are seeing. But first, I think, sometimes we might want to choose our words carefully. We say oil, oil, oil. But let's remember we're talking about the lifeblood of modern civilization. Oil is an essential commodity upon which our transportation systems, our agricultural systems, our defense systems, our economies, our medicines, our clothes, and everything else depends. And it is the sole commodity in those systems, certainly transportation. In electricity, we have alternatives. There's gas, there's nuclear, there's coal. In transportation, there's oil. So I think sometimes we ought to not say oil and say lifeblood. Maybe that's too long and gets wordy, but I think that's helpful. There's an expression in the United States, and I'm sure there's a Hebrew version, hope for the best, but prepare for the worst. I'm going to talk about the worst that we need to prepare for. I'm going to talk about 3 trends that most oil analysts, me included, and other government agencies, such as the International Energy Agency, the Department of Energy in the United States, see in the coming decades in the global oil market. They are not pleasant. The first is that dependence, the world's dependence on the Middle East and OPEC for the lifeblood of modern civilization is going to grow in the coming decades, not fall, from about 42% to almost half. The second trend is that the flow of oil in the world, the main stream of oil, is going to shift from the Middle East to the West to the Middle East to the East, to Asia. And third, because OPEC and Saudi Arabia are no longer playing the supply manager or price stabilizer role, oil prices are likely to be much more volatile in the future than they have in the past. Those are the 3 trends. I like to show slides and pictures, and we're going to go through some very quickly if we can mount that, if it's possible. If it's not, there we go. So the first trend shows you, and this is from our Department of Energy's recently released oil market outlook, an energy outlook. This shows you trends in energy consumption, dividing the OECD or rich world and then the non-OECD or developing world. And I'll go very quickly. It's pretty obvious. The demand growth in Asia, the Middle East, Latin America is going to soar, whereas our demand in the OECD will remain relatively stable. Most of that demand growth, here's where it's coming from, Asia. Asia's demand is going to soar. And the Asians and the Middle Easterners and the Latin Americans, turns out they like to drive. They like to drive big SUV cars. These are the fastest selling brands. They like train travel. They like plane travel. They like all the blessings. They crave all the blessings that we derive from oil. And that's happening now in Asia. So now the question is, Where will we get the oil to supply this soaring demand in Asia? Here's where. This is the components of supply. You see the demand will go from about 95 million barrels a day per year to about 105, or over 110 million barrels a day in 2040. I want to draw your attention to just a few of these bars. Notice the red bar. This is United States shale oil production, a wonderful new source of supply that nobody expected 10 years ago. It is a wonderful thing for energy security, for the U.S. economy, for global security, but it is not a game changer in terms of the amount of oil we need to find. At the bottom of those bars, you see some blue bars. Those show you the amount of oil. The blue bar at the bottom is the amount of oil from today's fields, pumping today, that is going to decline. And the other blue bars show you oil supply from fields we either haven't found yet, we don't even know where they are, or we found them, but we haven't invested one shekel or $1 to get the oil out. We hope, we expect, but we don't know precisely where that oil is coming from. Now, this shows you the world's oil supply by reserves. You see the first trillion barrels there has been consumed already. The next trillion barrels, God chose to put in the Middle East primarily, the lower cost oil. As we go higher, we have more expensive oil. And there you see shale oil, that little new green bar, is the new contributor to supply, but it is expensive. Okay, this shows you who will be supplying oil in the coming decades. See the blue line I've circled there? Most of it comes from OPEC. OPEC has the lion's share of the oil, the cheap oil, and OPEC's oil is expected to be produced mostly going forward. Now, prices. Here are projections of crude oil prices. Because of soaring demand, and because the remaining oil is more high cost, the price of oil is expected to climb to about $150 in the base case in the coming decades. You have different cases there, high oil price, low oil price, but most analysts, myself included, expect the trend for oil prices will be going up. Now here's the really scary chart. If you take OPEC will be supplying more oil and the price will be higher, then OPEC is going to earn a lot more money from its sales of oil. Just last year, OPEC's sales fell to $455 billion. That's down from almost $1 trillion in 2012 because of the low oil price. But because of the trends I described, we have to expect that OPEC countries will be earning a lot more money, up to and beyond even $2 trillion. Who in OPEC will be earning this money? Next slide. Mainly the Middle East. And you know the countries involved there. So hopefully this has made my first point, that analysts who objectively analyze supply and demand expect OPEC to earn more money in the coming decades, a lot more. Next point, the flow of oil in the world. This shows you how oil supply has flowed out of the Middle East to the world in the last few decades and then going forward. You see, in the last few decades, oil principally flowed from the Middle East to West Europe and the United States. And that flow anchored U.S. geopolitical interests in the region, very importantly. As you see going forward, that flow is going to reverse with portentous implications for geopolitics and global security. Last point, prices. This is a price chart showing oil prices going all the way back to the first well in 1859 in Pennsylvania. And what it shows you is the oil price has gone through long periods of relative stability and then long periods of wild volatility. We call this boom and bust. Boom and bust. And boom and bust oil prices are intolerable for the oil industry and for governments. How can you plan defense expenditures when the price of oil gyrates wildly? How can you plan your economy? How can you buy airplanes? How can you build factories? How do you know which type of car to buy if the price of oil goes like this? So three organizations through history have stepped in and attempted to stabilize the price of oil, to remove the boom-bust price cycles by manipulating supply. Mr. Rockefeller, and then in the 1930s, the United States. People forget that the United States created the most effective OPEC ever. OPEC tried to copy the quotas that United States oil states implemented, Texas and Oklahoma. Very, very strict. But as a consequence, OPEC is no longer able or even pretending to play this stabilizer role. As a consequence, we should expect more of what we have seen in the last 10 years, 115 to 27, 147 to 33, and then back up again. This is one of the most challenging changes in the oil market because it destabilizes economic planning, destabilizes defense planning, destabilizes countries. Look at Nigeria, look at Venezuela, look at Iraq. So these are my happy points for you. I'm going to end with a shameless promotion for a book I am writing on this new era of boom-bust oil prices. Let me end by saying that while we have to hope for the best and prepare for the worst, we have to address these realities with our best minds. And no country, in my view, has a greater incentive or a greater capability to address the challenges we face than Israel. Toda rabah.